the bank would tell you how much value you had in the bank. And if you were diligent, you would double check that. You would balance your checkbook. But ultimately, they're telling you where your value is and who has it and what portion of it you can access. This is a whole different model. This is, no. I own the value. I confirm my value. The World Wide Web and an algorithm is working with me to confirm that value, but I'm not reliant on Bank A, Pension Fund B to tell me where my value is or tell me when I can have access to it, Monday through Friday, 9 to 4:30. No. This is a 24/7 global validation of who owns what, who is transferring what to whom.
This is the fight of our lives, of humanity. That if we can keep this metaverse open, then we can control it. If it's closed in the hands of a Meta or some other group, then our whole reality will be closed off and we might not get back from that.
I truly believe this is the new battle for liberty. The fight for Web 3.0 is the fight against those big, powerful monopolies aligned with powerful political elites to control the choices we make. Liberty is core to human aspirational growth. I mean, the reason why people from around the world still try to emigrate to the United States or immigrate to Britain is to get that taste of liberty, to be free of powerful elites telling them who they can be and what they can be. And that's worth fighting for every generation. And this is where the battle is being waged today.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go? This is London Real. I am Brian Rose. My guest today is... This is London Real. I am Brian Rose. My guest today is Chris Giancarlo, the investor, attorney, author, and blockchain technology advocate. You served as chairman of the U.S. Commodity Futures Trading Commission from 2017 to 19, where you oversaw the first Bitcoin futures products enter the marketplace. You've been named as one of the most influential people in financial regulation, and your views on cryptocurrencies and digital assets are regularly featured in the Wall Street Journal, the Financial Times, and CNBC. You are the co-founder of the Digital Dollar Project, a not-for-profit initiative to advance the exploration of a U.S. central bank digital currency, where you believe the creation of a digital dollar is a critical move and one that will provide benefits around the globe. You are also the author of CryptoDad, The Fight for the Future of Money, where you suggest that money is too important to be left to the central bankers and that we owe it to the younger generations to explore the potential of virtual currencies. Chris, welcome to London Real.
Great to be with you, Brian. Great to be with you.
Look, it's fantastic to be here with you today. And I want to jump right into CryptoDad because it's a great handle and it's a great story. And when I look at your history, I'm looking at this seasoned Wall Street veteran who knows everything about some of the most complex instruments in the world, from derivatives to swaps to options, things that I used to even trade. And yet you're on holiday with your kids and they're telling you about this thing called crypto. And it sounds like you actually listened, and that maybe changed the future of what happened. So maybe you can tell me a little bit about that story, because it sounds crazy.
Well, so we had been looking at crypto at the agency for years. It started back in 2015 when the CFTC, the Commodity Futures Trading Commission, declared Bitcoin to be a commodity and therefore under its jurisdiction. And from there, we went forward into 2017 when I became chairman of the agency. And after a lot of consideration, we greenlighted the first regulated market on crypto, which was Bitcoin futures. So by the time I met with my kids, we had greenlighted it, we had been studying it, and it was all very academic and thorough and analyzed. But suddenly, the conversation with the kids brought a new facet to it that I hadn't appreciated, and that was the generational aspect. That's one thing that all of the spreadsheets, all of the staff presentations hadn't quite brought out, that this was a generation, unlike mine. Look, I had an institutional relationship with a bank when I was in high school because I had a summer job and I needed to cash my checks. But these kids, long before they set foot in a branch bank, had had social media accounts. They were online shopping. They had mobile devices. For them, a branch banking is a foreign subject compared to these other relationships. And my kids were gamers. They were trading tokens. They were trading suits of armor. They were engaged with people in games that were all around the world. And everything was instantaneous. And suddenly, the financial system, 3 days to settle a check, difficulties moving money around the world, fees, physicality of having to go into a branch to get things done was so foreign to them. And their enthusiasm for crypto is really what set the light bulbs off, that there's a generational thing going on. And Brian, you and I know, life's a conveyor belt. They're back on the conveyor belt now, but they're moving forward and they're taking these views with them.
And these are probably the same group of people that you couldn't get too excited talking about a derivative or even a share of a stock. And yet when it's crypto, all of a sudden it becomes something they can relate to. It's part of their life. They understand it and then they use it, which is ultimately the definition of something that's important if it has utility.
Well, so there's one of my favorite authors is Douglas Adams, who wrote The Hitchhiker's Guide to the Galaxy.
I read those books when I was a kid in high school. Amazing.
And he said, whatever era you're born into is exciting and the process of a lifelong career. If it happened before you're 35, it's exciting and it's the future. But if something happened after you turn 35, it's dodgy, suspect, and needs to be repressed. And I'm paraphrasing what he said. But you find that in the crypto world as well. People tend to be over 35, used to the existing financial system, seeing this new architecture of money as something suspect. But if you're under 35, it makes intuitive, immediate sense to them. And the legacy system that you and I grew up in, that we worked in, that we supported, is something that's foreign to them. This generational issue is not only not going away, it's going to grow and grow. And this is a truly generational, transformational moment in the history of finance, in the history of banking, and the history of money itself.
Yeah, and I want to talk about that because it's very surprising always to see someone with your background and your history going head on into this and telling everybody that this is something we have to embrace. We have to make sure that it's regulated the proper way, and this whole do no harm mentality. You mentioned kids. My daughter, she's 17. I had her on the show. She now has a wallet with cryptocurrency. She owns assets. I don't know about you, but when I was 17, the only asset I owned was my 68 Ford Mustang, and it didn't return any yield. These kids,
it would now.
Yeah, I know it would. You're right. But like they actually are comfortable with assets because of the gaming world, and now they might actually have something that gives them a return. It's a whole different relationship with money than you and I did, where I remember going to the branch and having my little book and having the balance, and the bank controlled the money. That's not the way the kids are understanding it these days.
Yeah, so the bank would tell you how much value you had in the bank. And if you were diligent, you would double check that. You would balance your checkbook. Right. But ultimately, they're telling you where your value is and who has it and what portion of it you can access. This is a whole different model. This is, no. I own the value. I confirm my value. The World Wide Web and an algorithm is working with me to confirm that value, but I'm not reliant on Bank A, pension fund B to tell me where my value is or tell me when I can have access to it, Monday through Friday, 9 to 4:30. No. This is a 24/7 global validation of who owns what, who is transferring what to whom, and in most cases, peer-to-peer. Now, are we there today? No, this is what's on the horizon, but this is the world our kids expect. Okay, and they're not going to accept the limitations, the intermediation, the third-party validation that you and I grew up within.
Yeah, and you've said, I think you might have said maybe in front of Congress, where you said, it strikes me that we owe it to this new generation to respect their enthusiasm about virtual currencies with a thoughtful and balanced response, not a dismissive one, which is something we always seem to feel from Washington. Even the kids feel it from their parents, and that you're now saying, no, we cannot do this. Let's proactively go into this. And so you've been delivering this message to financial institutions, governments, regulators, who aren't naturally attuned to this idea.
Well, let me tell you actually that story of where that line came from. And it's actually where I got the nickname CryptoDad. So as I said, in 2017, I'd become chairman of the CFTC, and we were focused on crypto. We had set up something for the first time in the federal government. We created something called Lab CFTC. We did it in the spring of 2017. And we immediately assigned them to master everything you can find out about Bitcoin, Ethereum, and some of the other leading cryptos. And bring the power of the agency, the data capability, the data analytical capability to bear. It got to the point where in the spring of 2017, our Lab CFTC was walking the commission through how to mine Bitcoin. In real time, we were doing it in the boardroom of the commission because we were that determined to master this asset class. We knew that some of our large American exchanges were soon going to approach us about basically operating Bitcoin futures in the marketplace, and we were going to have to look at that application and greenlight it. And so we made the decision to go forward. Not easily. We got incoming opposition from European regulators, from some US regulators, from some industry groups, trade associations, and the financial press in some cases were lampooning us. Oh, who do you think you are, greenlighting this?
Somebody took a full-page ad out in the Wall Street Journal saying not to do it, right?
Exactly right. But we went forward anyway, and not long after we greenlighted in December 2017, I got a formal summons from the Senate Banking Committee to appear before them. And I was appearing alongside Jay Clayton, the chairman of the SEC at the time. And Jay and I, optically, were taking very different approaches. We had just greenlighted Bitcoin futures. Jay and the SEC were cracking down on ICOs. And so it was very apparent that going into that hearing, one of us was going to be a goat and one of us was going to be a jackass, depending on one's point of view. And I thought the opposition was probably greater than the support we were going to get. So I was prepared for a grilling over. And if you've ever seen any of these Senate hearings, you've got these senators on this raised dais, which is perfectly designed to look down on the people at the table in front of them. And behind us, we probably had close to 100 people packed in that room and lights and cameras. And I had prepared a 48-page, 200-footnote submission to the hearing explaining chapter and verse of everything we had done to greenlight Bitcoin, because I wanted to justify every decision we had made. But you only get a 5-minute opening statement. And I knew I couldn't summarize those 48 pages to the 5 minutes. In fact, I knew I didn't even want to try. I wanted to talk to those senators on a different level. And so when the light went green on my little dais thing and it was my time to give my 5 minutes before the gavel came down, I pushed the papers away and I made a sort of a show of saying, senators, I know I'm here as the head of a federal regulatory agency, but I just want to talk to you as a dad for a minute. And that's when I explained. I said, I've got 3 kids in their 20s. I tried to interest them in the stock market when they're younger with no interest whatsoever. And yet all they now want to talk about is crypto. And that's when I said, the light's gone off for me that there's a generational interest here. And yet we can surely dismiss it. But why don't we do something different? Why don't we respond with a thoughtful and intelligent response? And it was when I said I want to talk to you as a dad that I got the handle CryptoDad. But the point was, there's to appeal to these legislators at a very human level that there's something going on. And I saw quite a few heads nodding. Right. They'd had some of the same conversations with their own kids.
Right. So it worked, or it started the process. Because we've seen a few of those moments, even in the last 18 months, where you see some of these maybe subcommittees actually knowing what's going on with crypto. Sometimes their constituents are already talking to them. And maybe for the first time in a long time, we see that maybe people are listening when it comes to regulation. But back in 17, very early, in 18, very early days, and hard to start that conversation, especially in the midst of the ICO boom and bust.
Yes, yes. No, it really is, but you're absolutely right, Brian. The light bulbs are starting to go off. And the funny thing about and we use the shorthand crypto, but this is much more than crypto. I tell people, this is about an entirely new architecture of finance, of banking and money itself. This is much more than, I think some people see it as just some funky new asset class. And to some, it's a dodgy asset class. To others, it's an opportunity to make millions overnight. But it's much more than that. The California gold rush was at first about millions overnight. Eventually, we could create the state of California and one of the world's largest economies, right? Revolutions happen and they bring many things with them. This is about a revolution it's bookkeeping without bookkeepers. It's using the World Wide Web to validate who owns what. And it's not just money, it's all things of value, right? When people tell me they're skeptical, I say, well, isn't it somewhat naive to look back over the last 30 years and see how the internet has changed social networking, online retail shopping, photography, music, entertainment, transportation, and to think it's not going to do the same thing to money and banking and finance? It is. It's going to revolutionize it in the same way it revolutionized that. And some of those great incumbents that we used to know, like Kodak, gone. Sears Roebuck, gone, right? Are gone. And to think that the same thing's not going to happen in finance, it will. Now, some of the incumbents will also evolve and survive, but the world of money and finance is going to be very different in 15 years from now than it is today.
Is that the best analogy you use? This is like the internet back in '98. That's what I hear that people say as a comparison. Or I've had also guests on here that say this is going to be 10 times bigger than the internet.
I think it could be because it involves money. So the first wave of the internet was an internet of information, right? It took information that was controlled by central operators, right? If you want to know anything about Edinburgh Castle, the starting point was Encyclopedia Britannica, owned by a corporation. Anything you got from that, you paid a fee to access it. License fee, subscription fee. You went to the library, which paid a fee, but that information was controlled and disseminated from the inward out. What did the internet do to that? It made information available on a peer-to-peer basis, right? So the internet of information was the first wave of the internet, democratizing information, democratizing social interaction, and it extended to the phone company, right? We paid a lot of money to people who owned rails to take phone lines across the Atlantic to anywhere in the world. Now we use the World Wide Web of computers to communicate by FaceTime for no cost instantaneously, right? So the first wave of the internet and internet information transformed social relationships, transformed so many things. The next wave, an internet of things. Okay, people can talk to each other. Now let's have devices talk to each other, right? Internet of things. Everything we buy, every place we shop, every place we dwell, every automobile we travel in is now connected to other appliances around the world. Well, we're now going into a third wave of this internet, and this is an internet of value. How do we take value and move it around the world as simply as we take communications? If we can text somebody around the world in a second, if we can send a photograph to somebody in the world in a second, why can't we move money? Why is it still the quickest way to get money from New York to London is to stuff it in a suitcase and get on a plane?
No, faster than a bank transfer.
Faster than a bank transfer, right? And yet we can I could text you in a second, but if I need to give you $10 for the bet I lost to you, I've got to get on a plane and give it to you because it'd be too expensive and too unwieldy to send it by wire transfer. Well, that's going to change. And it's going to change, and this goes back to that generational issue. It's going to change as much because the technology now makes it possible, but even more because a whole new generation expects it to be possible. Right. And that's the real driver.
Right. That's what makes you say, okay, this is happening whether we like it or not. And is that the message you give to the institutions and the regulators you meet around the world, is that this is coming, it's coming by demand, and we have to find a way to make it happen and not dig our heels in? It's
the message I was giving from 2015, 2016, 2017, 2018, and into 2019. Now they know it's happening.
Right.
The wiser heads see it's happening, and now what they're realizing is in the legacy system that they're a dozen years behind. Now the legacy system is not asking, is it going to happen? The question is, how do we catch up?
Right, right. So does that make your conversations easier because they're a little more urgency? Or also does someone desperate make sometimes desperate decisions?
Yeah, well, so it makes the conversations are as complicated because like new technology, like explaining the internet when it first came, it is somewhat complicated. It's different. It's a complete paradigm shift. But quite frankly, the legacy system is pretty complicated. The legacy system is kind of cockamamie. This whole thing with paper checks and are they honored and account novations and moving. I mean, it's a kind of complicated system, but we grew up with it. We understand it. It's not necessarily a simple system, but it's one we understand. This new paradigm, in some ways, is simpler, but in some ways, because it's new, it's hard for people to wrap their hand around it. And I don't mean this in any way derogatorily to people of an older age, but it's almost as if the older the person is, the harder it is to undo their understanding of the existing system to accept the new one. For young people who have been getting this since they're 14, so they went online at age 13, and ever since then they get this intuitively, so they get it. It's almost as if we need to take young people and have them speak to their elders about this all the time.
Right. It's such a fascinating generation gap. Let's talk about you actually regulating the Bitcoin futures, because it's probably a very important thing to talk about how you did it, why it was important, because ultimately everyone keeps asking, when will the institutions get involved? And we've all been told that they're still not yet involved. My pension fund, my insurance company, a bank's balance sheet still doesn't hold these assets. Yes, Michael Saylor, MicroStrategy has Bitcoin on his balance sheet. Elon has a bit, but we don't see yet that institutional adoption. Can you talk about what that road is, and then what you did back in 2017 to create that Bitcoin future, still very early, when you look back that you got that done?
Yeah, so let me explain some dynamics, because we have some unique dynamics in the US that perhaps different than elsewhere. So first of all, we had a very different administration in 2016 through 2020 than we do today. And I don't want to make qualitative judgments, but I would say that the environment within the Trump administration for crypto was ad hoc and uncoordinated. As I think the Biden administration is trying to take a more coordinated, more here's the game plan, folks. Everybody's got to be on the same page. And some of that is simply a function of we're further down the technology development phase. The other difference is in the United States, we don't have one market regulator at the federal level. We have two.
Yeah, this is important.
It is important. We have the SEC, the Securities Exchange Commission, and we have the CFTC, the Commodity Futures Trading Commission. And I'm often asked, why two and what do they do? Because the United States is the only major economy to have two. Well, here's what they do in a nutshell. Very simply, the SEC regulates markets for capital formation and capital transfer. Somebody with a great idea that needs money can find people with money but don't necessarily have an idea with as much promise, so they meet each other and businesses are formed. Capital formation, whether that be in the form of debt or whether in the form of equity, the SEC oversees markets for capital formation, and they're primarily domestic markets, although the world comes to the US for capital, but those markets are primarily domestic.
Right, typically stock market, corporate bond market.
Exactly.
We're talking here.
Right, exactly.
Okay.
Well summarized. Okay. That's not what the CFTC does. The CFTC is a market regulator, but it doesn't oversee markets for capital formation. It oversees markets for risk pricing and risk transfer. What does that mean? Somebody with an enterprise, a business, that has risk of moving of commodity prices, moving of benchmarks like interest rates or foreign exchange, has the risk that they'll sell their products but not get as much money back, or their products will cost more because commodity prices have gone up. Or they're a farmer. They don't know, they plant in the spring, they don't know what price they'll get in the fall because commodity prices are moving. They've got risk. So they go to these markets and say, I've got risk of prices and I don't want to bear it. I can't bear it, or I'll bear half of it. Does anybody want to buy half my risk? And that's what derivatives do. That's what futures and options do. They are risk controlling mechanisms. The United States has the world's largest risk transfer markets in the world, and because most of the world's prices for those commodities, soybeans, oil, wheat, cotton, interest rates, the world's interest rates, the world's exchange rates are priced in U.S. commodity markets. And to me, it's not a coincidence. It's actually a consequence that the United States has a specialized regulator just overlooking those risk markets, that the United States risk transfer markets are the world's largest. And fortunately for the United States, most of the world's risk is priced in dollars, which is a tremendous advantage and a tremendous support for the dollar as a reserve currency. So I think the United States brilliantly created two regulators. In fact, it used to be those markets were entirely agricultural. If something didn't come out of the ground, there wasn't a risk transfer instrument on it. Oil, cotton, wheat. But in the 1970s, a few brilliant market engineers, Dr. Richard Sandor, Leo Melamed, and the great economist Milton Friedman, basically arrived at something called the financial future. In other words, if we can control the risk of prices of wheat going up and down, why can't we control the movement of interest rates going up and down? And the United States could have never gone off the gold standard. In fact, the world could have never gone off a gold standard if you couldn't control the risk of interest rates between one country and another moving, or of foreign exchange rates. And so the United States invented this thing called the financial future. And then policymakers in Washington said, you know what? We actually need its own this risk control instrument is so important. We need a specialized regulator. And they went to the Department of Agriculture, found the Commodities Exchange Bureau, took it out and created the U.S. Commodity Futures Trading Commission. And that's when the commission became an independent agency and a sister agency to the SEC. And that's the origin. And Leo Malamed writes about this in his new book, Man of the Futures. That's the origins of the CFTC. It was created because of the fear that the SEC just couldn't move fast enough. And so the CFTC was actually given a mandate for product innovation. More new products have been evolved under CFTC governance in the last 20 years than all the world's market regulators combined.
It's like 12,000 or something.
Like 12,000 in that period of time. It's remarkable. So here's my point. It was almost a natural that Bitcoin futures would have been launched under CFTC regulation. Right. The CFTC has in its DNA new product innovation, whereas the SEC, with great respect to the SEC, is more of an investor protection focus. And so if there's risk involved, they're cautious. Whereas the CFTC, if it's innovative, their approach is, let's see how it works in the marketplace. We'll provide a regulatory wrapper, and that's what we did. So going back to 2017, when we looked at this new product, the agency, our response was not, might some people lose money or make money? Do we need to protect consumers? Although that was an important issue. Our more focus was, how do we put the right regulatory structure around it so that it has the best chance of succeeding, but also it brings it within the regulatory envelope, and we can put our analysts on it, we can put our crime fighters on it, we can police it for fraud, manipulation, and bad actors. And our track record, CFTC's track record in prosecuting Bitcoin and Ethereum fraud is actually second to none. So bringing it in with the regulatory envelope doesn't mean creating the Wild West. It means actually putting cops on the beat to police it. But our view was better to have it within the tent where we keep an eye on it rather than denying it legitimacy, and therefore bad actors have free range because there's no cops on the beat.
Yeah, this is such an important point, and if we're losing people here, please try to pay attention to this, because the SEC as an entity, and I had to take my SEC exams when I went to New York City back in '93. I spent my summer studying for my Series 7, Series 63 exam so I could become a licensed broker-dealer and trade at Bankers Trust. And that agency was created on the back of the stock market crash in '29, because that damaged a lot of consumers. Now, my mom, she's 78 years old. She lives in San Diego, California. She owns property assets. She also has some Ethereum and some stable coins, thanks to me. And it was there to protect maybe people like her from buying the wrong stock that was, who knows, pumped and dumped and never been, actually regulated. And it was created to protect that consumer.
Yep.
And so like you said, it always has this lens of protect the consumer, or if you have said maybe it goes to the lowest common denominator. Ultimately, it was created to protect someone from fraud. The whole country lost money, the world lost money. Whereas the CFTC was created to actually help create products, create liquidity, regulate those. So even the mentality is one of innovation as opposed to protection, which isn't bad, but it changes the flavor of how they behave.
Yeah, and with great respect to the SEC, for which I have a great deal of respect, I do think they do need to rethink this notion of consumer protection that basically says, if you're rich and sophisticated, what's called an accredited investor, you can invest in anything you want. But if you're young, which almost by definition means you don't have a lot of assets because you're young, right? You will in time. If you're young, you can't engage in anything but the most commoditized, stable, and that's not going to grab their attention. So we've got to find some way, I think the SEC's got to find some way to reconsider this and open up more avenues to investing. You can't have reward without risk, right? I mean, I'm saying this as a former regulator, right? We've got to find some give in the system. It's not the job of regulators to stamp out all risk. Risk is part of life, right? The original concept of our securities regulation was don't stop people from investing. Just give them adequate disclosure, true disclosure, right? If firms say something is something, it's got to be true, right? Give them true disclosure, but let people make their own decisions. And I think we need to get back to that concept in investing. It's not the job of regulators to squeeze all risk out of the system. It's to illuminate risk so that market participants, whether they be young and engaged in crypto or older and investing in pension funds, can know what they're getting into.
It's a great point, and I found myself a little frustrated as I've come back into the crypto space for the last year, and I start looking at it through the lens of just as an investor, and I look at, is a cryptocurrency asset a security? Does it pass the Howey test? And as I start to look at it, part of me stops halfway through and say, wait a second, we're asking the wrong question, aren't we? We're using an antiquated case study and story to look at a new token. Who cares if it passes the Howey test? What are we doing with that? Why is the SEC involved? Shouldn't we be empowering the use of this information?
Absolutely. That's where we've got to get to. And this generational thing, I always come back to that in my analysis of this, because a generation moves forward and they take these ideas with them. And I think the legacy, not only just the legacy financial system, the legacy regulatory system is on the parapet with a revolution going down beneath them. And I think they've faced the same risk that the legacy system is. If they don't evolve with the times, they're likely to be run over with the times. This new generation is impatient for being able to do financial transactions instantaneously without Big Daddy telling them which ones they can do and which ones is too risky for them. Right. And I think the regulators need to have the same light bulbs go off that the legacy financial system is.
It's tricky when your institution was created, 100 years ago to do just that, or your institution was created to create liquidity and empower and innovate, actual new instruments. So you got these two things, and now, looking at these things saying, okay, is a token a security? Is it a commodity? Which I guess is my next question. You clearly said Bitcoin is a commodity and we're going to now put it as a future, as an exchange. Then you crossed over to Ethereum and I think made that decision. Talk to me about that decision. Is Ethereum a commodity? And then how do you start to look at other tokens? And then how does it work with SEC remit going forward?
Yeah, so it's challenging.
Yeah.
The final decision about Ethereum was made by my successor. We had done a lot of the early work on that, so I don't want to speak for him. I'll let him do that. Bitcoin, I was very much engaged in that decision. Bitcoin operates very much like a commodity. I mean, it functions in the market like a fixed supply commodity. One of the criticisms of Bitcoin is its volatility. And I tell people that's not a design flaw, that's a design feature. Commodities 101, if you have a fixed supply commodity and demand rises or falls, there's only one reaction, price reaction. That's the only thing can make up. Even variable commodities like oil are very volatile. 2 years ago it was below zero. Now it's $100 or thereabouts, right? And yet you can adjust the supply of petroleum, up or down. It takes time to get the wheels flowing, but it's an adjustable supply. So Bitcoin is not flawed because it's volatile. It's a direct reflection of the fact that it's programmed scarcity. That scarcity is programmed into it. So Bitcoin functions very much like a commodity, very much like a digital form of gold, a very good store of value, not a particularly effective means of payment, and yet for its miners, it does serve as a means of payment for their efforts. So Bitcoin is a very unique, but the thing about crypto, again, it's a shorthand label for a much, much bigger re-architecting of money. We say crypto, people often refer to Bitcoin, but then there's stable coins, there's security tokens, there's so many aspects to crypto. As you know, as your readers well know, there's thousands of different cryptos, more creating all the time, and some have greater or lesser value propositions. Some of them are absolutely fascinating. I read white papers regularly. People send me, we're designing this new thing, and I learn something from every one. I mean, there's some really, really forward thinking going on out there, and it's not going to slow down. But crypto is more than that. It's NFTs. It's payment systems. It's blockchain uses for both wholesale and retail. I mean, this is a true, I think, revolution in the whole concept, the whole way we do finance, the whole way we move money around the globe, the whole way we are going to price value. And I'll give you one more point. Yeah. Throughout most of human history, money has been valued in commodities. Throughout most of human history, fiat money was either a commodity, a silver coin, a gold coin, or when we were on the gold standard, priced to a commodity. The dollar was priced to gold. Currencies were priced to gold. It's a short period of time in human history, the last few decades, where most of the world's goods are priced to a currency, the dollar. In the future, currencies may be once again priced to commodities, and that commodity is very likely to be a digital one.
Right. I had Dan Tapiero here at 10T Holdings, and he said, Brian, crypto is like the steam engine. It's a piece of technology that made the whole world better. And now we have a way of cryptographically ensuring that this asset is secure or it has a specific monetary policy. Is that the way you look at these things, as a new piece of technology, and that's why the future could be this digital money? And can you explain that to most people, regulators, banking institutions, et cetera? Or is that the way you look at it?
That's one way of looking at it.
Okay.
It is technology. The value of crypto, to me, is less in the tokens than it is in the underlying blockchains, right? And basically, the token is a call on that blockchain. It's an ownership of that blockchain. The value is in the whole as opposed to the individual pieces. There's also another notion. So it is technology. It's a technology revolution in money. One of the aspects of our existing financial system, so I always say there's three shortcomings. Let me even back up further. From the dawn of human history, from the time we came out of the forests, and until about 400 years ago, there was really only one form of money, and that was fiat money. That was something where the token was the representation of value, and the way you validated a transaction was to validate the token. You know the old cartoon character taking the coin in his mouth to see whether it's wooden or whether it's metal, right? So you validate the token. You take a $10 bill, you take a 10-pound note, you hold it up to the light, you look at the different features of the instrument, you validate the token. And that system really worked great until we discovered its major shortcoming, and that is it's local. Tokenized money works locally. $10 bill works in New York, it doesn't work in Paris. The 10-pound note works in London, it won't work in Singapore. And so the problem with that system is in this age of discovery, when merchants would travel around the world, the local nature of tokenized money didn't work. So they came up with a different system, the banknote system. Dutchmen deposited the guilders in the Bank of Amsterdam. It gave them a banknote, and they go to Venice with that banknote. And suddenly now the banks aren't validating the individual. What they're doing is taking the credit of another bank. And that is 90% of the money we have in today. Whether you use a paper check, whether you use Zelle, Venmo, whether you use most of our electronic systems, it's a bank-to-bank transfer. It's banks trusting the credit. Now, they do need to establish, however, that you have an account with that bank. And so therefore the shortcomings, once we went to a banking system, is it's exclusive. You can't join the club of financial inclusion if you do not have credentialed identity. Right. And in a world of 8.5 billion people, when 1.5 billion do not have identity, are excluded from our existing financial system. The shortcomings of the fiat system was it was local. The shortcomings of our bank system is that it's exclusive. It's slow, and it's expensive, because all that identity has got to be confirmed, who you are, who your bank is, et cetera, et cetera. So if you go into a shop with a $10 note, they validate the note. If you go in with anything else, they got to validate who you are, where you bank with, and it's going to take time for all that money to move around. Here's what crypto changes. No longer is it local. It's around the world in a second. No longer is it exclusive, because you don't need identity anymore, and no longer will it be expensive and time consuming. And so it solves the four shortcomings of everything we've known so far: the local nature, the exclusivity, the slowness, and the expensiveness. Today, financial inclusion means credentialed identity. Tomorrow, it'll mean computing power. If you've got computing power, you will be able to go into the financial system of the future, provided we don't get one thing wrong. And that is that we don't overlay on the future of money the AML KYC, the anti-money laundering, know your customer requirements that we require today. Because as important as that is as a law enforcement tool and as a control tool, it actually is the key reason why we are financially under-included. Because big portions of populations, not only in the developing world, but even in our own developed world, either do not have credentialed identity or don't wish to have credentialed identity, and therefore they're excluded and they're reduced to using fiat currency. We can open up this new financial system to much greater financial inclusion and still do AML KYC, but not using the current methodology we have today, which is identity first, financial transaction second.
Okay, this is a really important question, one that comes up all the time on the show. I've had people like Mashinsky of Celsius saying, keep the money clean, KYC, AML, the institutions that come. Stani Kulichev of Aave saying, show the liquidity, the institutions will come, and don't make them prove the KYC. You've just talked about this world, this future world. Well, we don't want to overlay this old school KYC, AML protocols on the future. You're saying it couldn't be computing power instead. What, I don't understand. Okay. What does that future look like?
All right. So I explained to you how we went from fiat money to banknote money. Okay. Long before AML KYC came around, that banknote system required someone to verify that they have a bank account. So you show identity, right? Yeah. And then the bank, you have sufficient funds and transfer the funds. So the first step in that transaction was identity first. Along in the 20th century comes AML KYC, and they basically adopt that methodology to do anti-money laundering. ID, we're going to get people's ID first, right? Because that's already what was in the underlying architecture, so they just layered it on. Okay. But what's happened today is, because we've so come accustomed to that methodology of AML KYC, we confuse the current methodology with the policy. The policy of anti-money laundering was good policy, but there's many methodologies of getting there. It doesn't always have to be identity first. If I want to buy a $10 sandwich, why does the system need to validate who I am? It doesn't with cash. Why should it have to do it with a financial transaction, right? In fact, look at other forms of law enforcement that we use every day. We don't get identity first. Look at highway safety. Before getting on the highway, in fact, before freely getting on the freeway, you don't have to stop at a toll and say, here's my name, here's where I live, here's where I bank, here's my social security number, your ID number. No, you freely get on the highway, and law enforcement uses pattern recognition. Right. If you're speeding, if you're reckless driving, to identify the possibility of unlawful contact, they will then stop the activity and then get your identity. Identity not first, but identity last. The same technology that gives us blockchain will give us the ability to do an identity not first, but an identity last system. How is that? Because we use big data analysis, pattern recognition, the same technologies that Facebook and eBay are using every day to look for consumer trends. We'll look for trends of illicit conduct. And when we find them, and those technologies are very good, we'll then shut down the activity and get the identity as necessary to prosecute them. Now that may sound like a big change, but we have to be honest, Brian. Everybody knows the existing system's not very good. Right. We spend more money to run the existing system than we capture criminal activity. It's got a 96% false positive rate. We're gathering way more information on our fellow citizens and excluding a lot of citizens who would like to come into the financial system by insisting identity is a first step. Identity doesn't have to be a first step. We could do a better job of anti-money laundering if we didn't require identity as a first step, if regulators would go from being reactionary to go to being proactive and become quantitative regulators. I gave a speech in 2018 calling for my fellow regulators in Washington to become quantitative regulators. We need to adopt the same technology that's being used in commercial avenues to do law enforcement online without invading people's privacy, because they may be entirely innocent. Unless the pattern shows a probable cause of illicit activity, government shouldn't have your identity as a first step in every transaction, unless government's objective is more than anti-money laundering and it's to actually surveil people's economic activity.
Yeah, this is an important point, and I'm really glad you made it. And people wouldn't expect to hear this from a former chairman of the CFTC, because they assume that all government people want regulation.
I do. I'm not against regulation.
Right. But like you said, there's billions of people around the world that are unbanked. A lot of them in the United States of America and the UK, they have to use Western Union and all these other policies in cash, which detracts from the economy. So you're think in the big picture, try to bank as many people as possible and do an intelligent form of quantitative regulation. And why do you have to have everyone's identity? Start really looking about the freedom.
Let people operate pseudonymously. Let people operate on an immutable blockchain, transact.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.